Once again, we are back to a particular lecture on cash flow now. In the previous class, what we have seen is the importance of the S curve and how the money is being paid based on the completion, percentage of completion. So x-axis mostly will be time, here will be the number of activities that are completed and percentage of completion. Now once you get this value, I told you whatever be the percentage of completion is there, that much amount multiplied from BOQ, you can give it. Our total project cost multiplied by percentage of completion. This much money you can release at a time. So sometimes what people will do is B by B payment also they take. What is B by B payment? This is back to back payment. Normally what occurs is in some of the big projects or corporate projects or government projects, there will be a main contractor MC, and MC will be having so many subcontractors. They are called to be the designated subcontractors. So client will choose MC and MC will, that is MC means main contractor. The main contractor will hire subcontractors. So this money from the client side, it will be released based on the percentage of completion to the main contractor. Once the main contractor gets the money, then he pays to the subcontractors, that is called B by B. That is back to back payment. Now in government projects, what happens? The client itself will get money from government somewhere where the fund is being allocated, and from there once he gets the money, he will pay to the main contractor. That is called again back to back payment. So back to back payment, normally this will be taken care within 90 days. 90 days of the bill submission. So what we have to do is, well within the 90 days, this whatever back to back or whatever type of payment is there, that has to be released. That is taken care within 90 days. So this curve plays a very, very major role in all these issues. So what we have to remember basically is SOW, number 1, scope of work, number 2, BOQ. These are two most important things. The number 3 will be for monitoring and controlling S curve. So in any project, whether it is either in India or abroad or wherever, these are the 3 things that will work. First thing is SOW has been written very clearly, and any clarifications you have to do at this stage. Any clarifications need to be done at this stage only. SOW. Later if you say, I have used this, I understood this like this work is not, it's very huge and it is not been detailed properly, then you will go for the fight, and there will be a lot of difference between the BOQ prepared by contractor and also the consultant. There will be a lot of difference in the money, the budget, and then the contractor and the client, contractor and consultant, they will fight because of these reasons. So most of the contractors, what they try to do, what I have seen in my life abroad, most of the contractors, what they do is, they don't try to work out BOQ in detail. This they don't work out, and they give a unit rate. Normally what they do, they try to see, suppose in scope of work, what is the amount of construction, suppose maybe 1000 square feet. So for 1000 square feet, they will work out a unit, this much money. Like in India, suppose now it is at the moment of 2200 to 2500, say. This is rupees per square feet. So if a big project is coming, a building is coming, normally contractors, they try to work out roughly as per based on the unit 2200 to 2500, depending upon the SOW, what requirements have been given, what type of tiles, what type of walls, what type of material, all this. What type of finishings, what type of connections that have to be given, plumbing and drainage and all that. So based on that, they try to work out 2200 to 2500 in India basically. Now the same thing they will work out for big projects, without going into detail BOQ, and they give only SOW. Based on that, they will give a unit rate, and later they say that this is not working. 2200, 2500 is not possible now. Now I have to go for maybe 3500. Then comes the problem, then comes the issue. This I will try to explain in last chapter, that is arbitration and adjudication. There I will try to work out and I will try to explain to you how it occurs. So then the fight will occur, and then they try to challenge the consultant or client in the court of law, and there the case will go. So BOQ has to be worked out very clearly. Wherever you are working, whenever you work with the projects, you try to see very meticulously SOW. Once SOW is clear, otherwise you have a sittings with the client and consultant. You sit across and then discuss SOW, what they want. Because most of the projects that are government funded or like big corporate offices, in SOW, they cannot mention the brand name. The brand name is not been given, especially in government projects and public sector projects. So when brand name is not given, they write the specification in such a way that that brand only will be suitable for using in BOQ. So that is how they compel the main contractor to go for that particular brand only without naming the brand in SOW. So that is how it works. So naturally, when SOW is there, you try to work out, sit across, get it clarified, everything. Only then there will not be this fight, this margin demand, this difference will not come. Once this difference will come, then you will be in soup, and also the consultant also and client also will be in soup. So BOQ work out very clearly, and then go to the S-curve, this one, and there comes the project monitoring and controlling. With S-curve, you can do it anywhere sitting, even in your office, you can sit and you can control and ask the people to go and just cut a line and then try to work out whatever be the percentage of completion here. And then this 90% is already written initially in the tender document itself, so you need not work out that one. Now I am going to the next most important topic, based on which we try to work out the project costs, and that it is called to be the cash flow. I remove this now. As the project starts building up, the cash flow also need to be built up. What is the cash flow? The cash flow is called to be the budget and initial opening and closing. So cash flow is called to be the budget that is available initially with the client. Because you may ask me that client will be having, maybe if the project is meant for 1 million, the client will have 1 million at the starting edge. No. Most of the people, they go into the market and they don't put 1 million for 1 million project. What they will try to do is, they try to have an initial cost. Under this, we call it as maybe for possession, or maybe all requirements, office works, all these things will work under the, and takeover, I mean land takeover, royalty, goodwill, all this will work out to be under the initial cash flow. So cash flow will be like a register. For example, you go to a bank, there will be a statement where date will be there and some activity will be there. Then you have the what is that called, debit, credit and balance. The same way, cash flow for a building also, for a project also, they have to maintain a register, a accounts register, and in this they have to say what is the initial budget, what was the opening balance and what was the closing balance. Every day they have to see. This will be always reported to the client. The cash flow will be reported to the client. If the cash flow is good, healthy, then only the project will go according to the time. Percentage of completion will be according to the time. Otherwise, if the cash flow is weak, that means the movement of money, the rotation of money is very weak for that particular client, then the project will not accomplish or it will not be completed as per the time, and cost and quality. So that is why all these things are come under, they all come under initial opening. So initial startup we say, then you have second cash flow is operating. Operating will be, this is initial, this is operating. Operating will be during the stage of construction. This is for starting. Maybe equipment, material, all this will come under this. Operating will be day-to-day salaries, day-to-day payments, and then day-to-day payments to the labor, to the staff, to the office, all this, and to the material and to the work. So this is operating expenses, or we call it as operating cash flow. This will be in the center of the project when the project has started, and then it is going on smoothly, then cash flow also should be backed by that. So cash flow should support this. Then the last one will be, the third stage of cash flow is the final. Final cash flow is at the end of the project, where you have finishings, for example, where you have certain aspects like permissions, for example, permission from environment, permission from so many, fire, for example, water, all these things, and many things like landscaping, and the final stages, whatever it is for finishings, that all there, and closing of the project, and closing down and handing over. So all these things will occur in this, the handing over of the project, the closing of the project, and all that. Of course, closing with only 90% of fund, 90% of payment, not 100%, as I told before. So cash flow can be divided into initial phase, operating phase, and final phase. Three different aspects of cash flow. Now, if cash flow is positive, then only the project will be completed well within the time. If the cash flow is negative, it is very weak, then it cannot be completed within the scheduled time. So cash flow is a very important thing which every company is worried about, and they try to see. Now during the recession period, because of this cash flow, at least 85% or 75% of the buildings were not able to be completed. When I got a survey done to a particular city, there we asked them to check BOQ and cash flow and link between these two, cash flow and BOQ. Now once they link these two, they come to a conclusion. They stated that 75% of the buildings completion was not done because of the stopping of the cash flow, because of lack of cash flow. Now normally cash flows are to be healthy, and they have to be very strong for any company to survive in the market and to take care of the projects and hand over it to the people or public or society, whatever, well within the time. Now normally we see that the cash flows are calculated based on three aspects. Basically, what are the three aspects? I will try to explain. Is first one is the discounted cash flow. Discounted cash flow. First one, discounted cash flow. Second one is NPV, net present value. Then third one is IRR, internal rate of return. So what are they mean? I will just try to give you the meaning of that. Initially, what is the discounted cash flow? And these three methods are used for completion of the projects. First one is the discounted cash flow. This is the value of the investment by looking at its expected future cash flows and discounting them back to what they are worth today. That means in future, suppose the project's worth is going to be 1,000 rupees. Today what will be is its discounted value. See, today we buy maybe a building for 50 lakhs. After 10 years, because of so many things like factors increasing, inflation and all these things, it may become 60 lakhs or 75 lakhs. Isn't it? That's what normally it works. And we even buy property because of that reason, so that we can sell it for a different price, a higher price. So discounted cash flow is what will be its expected future. What will be the project's expected future cash flow which is discounted back to what it is worth today. Suppose it is worth 50 lakhs today. After 10 years, maybe it will worth 75 lakhs. So you can work out the discounted percentage, how much it is discounted back. So today you invest 50 lakhs, but you will get after 10 years 75 lakhs. So this 25 lakhs will be your profit, what you will get. So what is the worth of that particular project today? And what will be its future worth of cash flow? These two things you have to work out in the discounted cash flow. Later I will try to explain that based on the value for money, time value for money, because this is called as time value for money. So normally we say based on the time, the value will increase. So based on the time, value also will increase. That is what we normally say, unless otherwise there is some recession. Now, time value for money, I will try to explain that money you have today, which is worth more than the same amount in the future. There is a famous saying that today's egg is better than tomorrow's chicken. So this is exactly what it means. I mean, in a very simple terms I am telling. Now, discounted rate at which the percentage can be reduced. Then NPV is the total difference between present value of cash flow and cash flow outflows over time, over a particular time period. What is the cash flow today and difference of that with the cash flow tomorrow? The difference only, because today the project is worth maybe 50 lakhs again for the company. Tomorrow it may be worth 65 lakhs, but people will buy it. I mean, somebody else will be there in between, an agent who will sell it for 75 lakhs. So tomorrow's cash flow is 75 lakhs. Today's cash flow is only 50 lakhs what the company has spent. So this difference is called to be the net present value. That means what is tomorrow's value, that you will forget. What is its value today? That is net present value today. I mean, today it is worth only 10 rupees. Tomorrow it may be worth 20 rupees. But you may say that I don't want 20 rupees, I want only this 10 rupees. So you invest 10 rupees only. Later you will see what will be its net present value tomorrow. So normally net present value translates the future money made or spent into today's money, today's cash flow. That is what it is done. Then net present value, if it is greater than 0, then the project is worthwhile taking. If net present value is less than 0, then you should forget about the project. Then the last one is the internal rate of return. This is the specific discount rate that makes the NPV of all cash flows equal to 0. That means internally you have to work out the rate of return and then try to make NPV as equal to 0. So what percentage of IRR is required? Because most of the fund that is obtained in the market or internally, it has to be paid at the rate of interest. What is the percentage rate of interest? That has to be calculated. So internally, what is the rate of return? We need to fix this value. Because you yourself may be spending the money, but you need some profit. So every month you need to get some interest, isn't it? That's what IRR explains. So I hope I will try to explain these three things in the next lecture by way of taking a numerical example, so that it will be very clear for you. Basically, I have tried to explain, and I hope you have understood that one. If so, it's okay. Otherwise, you can DM me